This is Trading-Lesson26, delivered by Ezugi. You're advised to subscribe, share, like, and make comments on this broadcast. It is for forex traders, cryptocurrency traders, stock traders, option traders, and other chart-related traders. You can contact us for account management, training, consultation on +234 803 75 97 085. A reliable sign that a pullback in a bull trend or in a trendy range has ended is when the current bar's high extends at least one tick above the high of the prior bar. This leads to a useful concept of counting the number of times that this occurs, which is called bar counting. The sideways or downward move, the bull trend, or a trading range, the first bar whose high is above the high of the prior bar is a high 1, and this ends the first leg of the sideways or down move. Although this leg may become a small leg in a larger pullback. If the market does not turn into a bull swing and instead continues sideways or down, label the next occurrence of a bar with a high above the high of the prior bar as a high 2, ending the second leg. There needs to be at least a tiny trend line break between the high 1 and the high 2 to indicate that the trend traders are still active. Without this, do not yet look to buy, since the high 1 and high 2 are more likely just part of a channel down that is forming a complex first leg down. If you think that the market is in a trading range, it is risky to buy a high 2 above the moving average and near the high of the trading range. In fact, since this trade will likely fail, you should instead consider shorting using limit orders at or above the high of the high 2 signal bar. A high 1 long trade after the initial spike up in a new bull trend has a high probability of being at least a successful swing trade. The risk is small and the potential reward and probability of success are high. However, if the market is forming its third consecutive high 1 setup, the odds of a swing are small, so traders should scalp. This means that the risk and potential rewards are both small, and the probability is less than it was for the first high 1. Some bull pullbacks can grow further and form a high 3 or a high 4. If the market is in a bear trend, you can often look to short above the high of the prior bar, because buying a high 1 in a bear trend is a low probability trade. If the market is in a tight trading range, do not trade unless you are a very experienced trader and you are comfortable shorting above the high of the prior bar instead of buying there on a stop, buying below the low of the prior bar instead of shorting there on a stop. When traders are looking for a reversal down, they often look for a high 1, high 2, or triangle, that is a high 3 pattern that they expect will fail and become the final flag of the bull leg, and then short above the buy signal bar. Most bottoms form from failed low 1 or low 2, or triangle breakout, which create double bottom and final flag reversal up. Since a trader is expecting a move up into a trading range or a new bull, a double bottom is also a high 2 buy setup, with the entry at one tick above the high of the bar that created the last push down to the double bottom. Everything is subjective, and the trader is always looking for something close to perfect, but never expecting perfection because perfection is rare. A high 1 is a buy setup only in a clear bull trend and not in a spike near the top of a trending range. A low 2, a low 1 is a short setup only in a clear, strong bear trend.